Hey everybody, welcome to this free edition of our Trader Use Group Weekly Roundup for the trading week ending September 9th, 2022. I'm Preston Brent. Thanks for tuning in. This week's theme is this another bounce higher or will it fail like the one that started off the June lows carrying us through August? Well, let's take a look at where we've been and where we could be going here over the next couple of weeks. If we look at the markets here, let's first talk about the U.S. markets. You can see this past week, a very strong week. Everybody's solidly in the green. Year to date, everybody's in correction territory. It's been a really horrible start to 2022 as we round out the first 3 quarters of the year. Sector performance wise, this week we saw discretionary do very well at 578 energy. Which was the worst, was still in the green. So we had one of those weeks where even the worst sector was in the green for the week. Valuation wise, you can see the forward PE is at 17.63. Dividend yield for the S&P is at 166. 10-year Treasury closed out the week 3.32, so still elevated. Earnings yield for the S&P is at 5.61%. That's using the forward guidance 12 months for estimated earnings per share at 229. I think that numbers are probably going to come down, probably to around 205, 210, which will lower the PE ratio, which will lower the stocks a little bit. We got the S&P yield over the 10-year Treasuries just about 2.3%. The real yield is negative due to the higher inflation rate. Current VIX came in. You can see here it came in at 22.79. Last week is 25.47, so it obviously wasn't flat for the week. It was down just a little bit, reflecting this big move higher that we had in the index performance. So this move this past week broke a string of 3 weekly losses in a row. I think investors get a little bit more confident that the market is reaching at least a temporary bottom. We got a lot of the Fed governors, including the vice chair, came out this past week. Lael Brainard, the Cleveland Fed president, Loretta Mester, both of them delivering comments that seem to be a little bit more dovish than expected. Traders also are noting that signs of inflation are starting to cool just a little bit. We did see the Fed's Beige Book, which represents all of the 12 regions across the United States, summarizing economic reports, basically saying that price increases are moderating in 9 of the 12 districts, citing lower fuel cost, cooling overall demand, reduce, I guess, shipping rates. Also, the Fed Beige Book noted declines in prices for steel, lumber, and copper. So all of this seems to show, at least for the moment, that have we reached peak inflation with it coming down a little bit. That also boosted sentiment for the week. Okay. Now, earlier in the week, we did get a little bit of conflicting information from the ISM and S&P Global. They had divergent readings on the August service sector activity. The ISM gauge was revised to 56.9. That's the fastest pace of expansion since April. Good news, right? But the S&P Global measure fell more than expected to 43.7, the biggest contraction since early 2020. So we're getting a little bit of mixed signals from some of the data. Meanwhile, the labor market appeared to remain fairly on solid footing. The weekly jobless claims coming in lower than expected. It came in at 222,000 versus an expected 240,000. So they're hitting the lowest level since the start of the summer. Meanwhile, the yield, as I told you on the U.S. benchmark, is at the highest level since mid-June when we hit our lows in most indexes. So we're seeing some of that translate itself into this bounce. And if we look at it, you can see going over across the pond into Europe, pretty much it followed suit all there as well. Everybody up, although not as strong as the U.S. markets, but they were up a little bit. Still, year to date, everybody's in the red. Okay. The ECB, we saw increase their key interest rate by a record 75 basis points. Their inflation in many countries are even higher than here in the U.S. It's the highest level of their current rates since 2011 with that 75 basis point rate hike. Their deposit rate now stands at 75 basis points because they started from zero. Okay. And their refinancing rate sits at 1.25%. So the central bank also over in Europe came out and said you can expect more rate increases over the next several meetings because they got to get their inflation down dramatically. Meanwhile, in the UK, the newly installed Prime Minister Liz Truss, announced that the government's going to intervene to help reduce soaring energy costs for British households and businesses. And the Bank of England indicated in testimony to their parliament that the government's energy bailout plan could force the central banks to raise the rates even further. So all across Europe, they're in trouble, from Great Britain over to the other countries that make up the ECB, the 19 countries that make it up. It's going to be very interesting to see how it shakes out, but you can see everybody's in the green a little bit. Now, if we go to the Asian markets, you can see the Nikkei was up 2%, China was up 2, Hang Seng fairly flat, but they're still in the red year to date. Japan, their stimulus continues. As I said before, the only two countries that are putting money into the economy instead of taking it out are Japan and China. And in Japan, the government announced a new package that's going to kick off in October to help the country cope with rising inflation. And in that package, they include cash handouts to lower income households, as well as measures to keep some commodity and food prices at current levels. So they're trying to do some price fixing over there through stimulus measures as well as handing out more money. That is part of the reason why the yen has fallen to its lowest level in 24 years. But the government may step in. Be very careful for any of you that are shorting the yen, because I've seen this happen several times where everybody gets short a currency and then the government takes swift action, which doesn't last long term, but over a month or two, it can jack up the yen against the dollar. And if you're short the yen, you could get hurt. So be very careful there. So um, they're talking about boosting certain things to help the yen in this free fall, right? Also, we saw GDP in Japan expand at an annualized rate of 3.5% in Q2. Their estimate was for 2.2%. So I think their economy, that increase was boosted by lifting some of the COVID restrictions and some of the stimulus that they're putting in there, encouraging businesses to spend and so forth and so forth. So they're still pumping money into their economy. I mean, I don't think they'll ever get back to their highs in the Nikkei that was made about 15 or 20 years ago. They're in a funk. And meanwhile, over in China, they're still really hurting. Their consumer and factory gate inflation data declined from July's levels, came in below analyst expectations, right? Consumer prices rose 2.5% over the 12-month period. Um, Factory gate prices rose 2.5%, down from the 4.2% the previous month. But again, the PBOC, the People's Bank of China, is trying to control their yuan because, like the yen, it's crashing because they're the only two countries, as I said, that are pumping money into the economy. So, but all of China is just hurting. They've got very bad real estate environment. They've got slowing manufacturing. Now, keep in mind that if their exports slow, that means Europe and the U.S. are slowing their purchases. So there's still some bad news to come. These are just some of the canaries in the coal mine that could set things off. Okay. Now, what I want to do is shift our screen, and let me just take you over to the SPX, the cash index. We'll just take a look at that this weekend. And what you're going to see, and it'll take about 15 seconds to come up on your screen here. You're going to see that we surpassed finally the 50 EMA. Okay. And here's the 200 EMA sitting right here. You'll notice that with this higher low here, could that be a sign that this bounce that we saw from middle of June through early mid part of August, is that a real bounce off these lows that were made back on June 17th? We were down about 24.52%. Well, not until we can clear this 200 EMA and clear this level right here. And if I were to mark it on the screen for you guys, you'll see it's 23.25. The futures, S&P E-mini futures, are very similar, right? So we need to clear this level, find it as support, and then I think we're going to run higher. But I don't know if we're going to be able to do that. Understand this next week, we've got some really serious data coming out on Tuesday. All right. Tuesday, we're going to see the CPI. And remember, there's two inflation numbers that we need to focus on. The primary one is not CPI, but core inflation, which is what the U.S. Fed's focus on. Take out energy and gas and some of those in food, some of the highly volatile areas, and then you wind up from CPI down to core. Now, the forecast for CPI is to come down from 8.5% to 8.1. That's all well and good, but the core is expected to move up from 5.9 to 6.1%. So they're kind of fighting each other right now. So I don't know how the market's going to react to that. The markets have already priced in a 75 basis point rate hike in September. That's 21st of September. So we've got inflation data and then PPI data, both consumer and wholesale inflation data coming in Tuesday and Wednesday of this coming week. And then we got Wednesday of next week, the Fed. So we could see a lot of movement in the markets, and they'll give us a little bit more clarity on how the Feds choose to fight inflation, as well as where we're going to go near term through Q4. I am still of the opinion that we're going to roll over again before we take out this 43.25 area, probably sometime in October into November, before we end up with another run into December. And that rollover could challenge these lows right here, down around 36.36, which is the low we had in the SPX. Okay. So we've got to be very, very careful here. Now, if we look at NASDAQ, because NASDAQ had a good finish to the week as well, you can see NASDAQ is challenging the 50 EMA. And you can see the 200 EMA, it really only managed to close above it one day, actually 2 days, but it sat on it and then it gave it all up again. Note this is an Elliott wave 3 leg down, which would suggest we would move up a little bit and then roll back over again. So the key for me in the NASDAQ is that low right there, 11,921 in the NASDAQ futures, E-mini futures. I want to watch that very closely. And then again, here's the high up here at 13,737. So in many respects, we're in about a 2 or a 3,000 point trading range. And until we get more clarity on the Feds, and we get more clarity on what their terminal rate is, which I think has now been elevated from 3.75% to closer to 4%, or at least that seems to be the way they're jawboning the market right now. Because remember, part of their policy, besides raising rates and quantitative tightening, which I think is going to cause probably more pain than people expect, is their verbal pronunciations that they do in their monthly meetings. They can verbally move the markets wherever they want to, and they usually do. And they may not even have to raise the rates as much, but in this case, I think they will. So they're warning the markets to expect more aggressive near-term rate hikes, and the markets can take that and heed that warning or not. I do believe the market's going to get it ahead of themselves. I think earnings revisions are going to come down in Q3 earnings. That's going to move the markets down. Remember, earnings kick off in the second week in October, so I'm usually early to these drawdowns, usually by 2 or 3 weeks. So we could see that drawdown extend into November timeframe. But that's what I do see coming up. Right now, we're in this bounce. And I'm not really sure. This bounce is now going to be driven by what we get out of the inflationary and the PPI data on Tuesday and Wednesday this week, along with the Feds. Okay. Now, if we come down here and look at the volatility, you can see VIX closed at 22.79. Okay. And that's off of this 3-week move lower that we had. And you could see the move higher in the VIX. And you could see the 50 EMA cross momentarily below, and then it moved back up again. And they're kind of railroad tracking itself almost in a flat area here. You can see this is an Elliott wave 3. It suggests we could see the VIX move back up over 30. If we move back over 30, that means the prognostication that I have that we've got maybe another week or so of movement higher, and then it's going to roll over again. And we got a lot of things on the horizon that can move these markets over. All right. Not as many that can move the markets up. So just understand the risk of the bigger move right now is still to the downside. Okay. We still have that downside risk. However, if we look at the front month volatility skew, you're going to see here in the skew, we're in the green. That means we're in a contango vol term structure. That is a normalized term structure through the end of August. Sorry, September. And then if we look at the back month term structure, which carries us out all the way through October, you can see we're real solid in the green. So if we do get what I anticipate would be a rollover in October, it will be a surprise to the markets, which means we'll get a faster, more negative reaction in the VIX, which means the VIX will move higher at a faster rate of change clip, which could set the markets on, a scare the children moment, moving them lower. That's what I'm expecting. Near term, through the next week, I think we could get chop, and then let's see what the inflation data gives us and what the Feds give us. That's what's going to drive the markets here near term. Okay. Of course, if we look at treasuries, you take a look at the bond market. The bond market is coming down to my target down here. I had a couple of targets down here. But this longer term target down here, let me just mark it here. Let's just set it on like this. Let's put it like this so that you guys can see it. If I mark it like this, and this uses a combination of fib and Elliott Gann, is saying it can run much lower, 10 full points lower in the bond market, which means interest rates could go a lot higher. If we do get a more aggressive Fed and they raise that terminal rate and confirm it more at 4 or possibly higher, you're going to see the bonds roll over even more, and then you're going to see interest rates go higher. You can see the range that I have from 122 all the way up to 149. That's a huge range, folks. That shows you the lack of clarity that we have right now in the markets. And we're going to get a little bit more of it, but not finalized, but we should get a little bit more of it in the Fed meeting on the 21st of September. Keep in mind, the Feds do not have a meeting in October, but they got one on November the 2nd. So we got one on the 21st of September, nothing in October, and then November 2nd, we get another Fed meeting. So I think it's going to take at least through November 2nd to get a better, clearer picture of where we are with inflation and what the Fed's terminal rate, meaning their final rate before they sit for 2 or 3 meetings and see what the markets want to do. So we're going to get a lot of volatility in the markets, I believe, near term, as we figure out just what the Feds want to do. All right, so just understand that. And then, of course, if we come and look at currencies, the dollar peeled back pretty good little bit on Friday. You can see it moved right into my rate. My anticipated resistance rate was 110.06. We went to 110.78, and now we're pulling back like I would expect. In fact, I would expect it to pull back and kiss the 50 EMA again, which would give a little bit more lift to the euro. And if we look at the euro, it lifted up a little bit, not a lot, but you can see here, and you can see the euro against the 50 EMA. I mean, we sat here for 3 weeks. We sat here for a week. We sat here for 3 days. Every one of them, we could not get over the 50 EMA. We're going to challenge it again. The 50 EMA is sitting at about 1.01. The euro closed at 1, essentially. So just a little bit of a move higher, and then we're going to see where it wants to go, okay? I think Europe is going to go into a deeper recession in the U.S., and that could push the euro down even lower. But it's hitting my forecast numbers near term, all right? So right now it's going to be chop, but that's kind of how I see this. And then if we look at the yen also bounced up off a 20-year low, but look at this. That is ugly, ugly, ugly. Until or unless we see a lift in several days above the 50 EMA, I wouldn't touch the yen. It's just ugly right now. Remember, the Japanese yen, the Japanese are putting a lot of money into their economy where the U.S. is taking money out. So that dichotomy is driving this yen lower. The only thing that can move it up right now near term is government action. And I think what they're probably setting up some tools in place to look at that. And if we take out these lows here that were made back on September the 7th, I think they'll do that, and you'll see the yen just move up big time. So, in some respects, picking up some long, further dated calls or trading the yen to the upside. Again, keep your position size very small. It's called the widow maker anyway for everybody trying to catch the bottom in the yen, and it's called that for a reason because it just decimates you. And if you had tried that trade, every one of these what supposedly were lows, you got taken out every single time. If we come over and look at gold and silver, I am still net short gold. I want to be short gold. You can see here how we're the 50s below the 200. It's a bear market chart. I won't change my opinion until we can get that back up again. All right. The odds favorite. In fact, my target for gold is down here around 1600. We may not get there, but I think it'll take out the 2022 low. Should we have the markets crater in 2023, the second half of 2023 into 2024, which is what I think is going to happen, then gold is going to start a nice little run. Right now, it's not ready for it. So I want to be long gold, but I think we can get in at a better price. So I wouldn't look at gold here and enter it along. Same thing with silver futures. If we take a look at the silver futures here, it has a higher beta than gold, so it tends to bounce around a little bit more. But the same thing. I think silver is going to come back down a little bit lower here, and then make a run, but not right now. If we look at oil, well, oil is going to be in this range for a while, in the low to mid 80s. You can see here, once we gave up the 50 EMA back over here in June, it's just been on this channel straight down, right? And we're still in the green year to date because we're above the 2021 close for oil futures. But I do believe that you're looking at the 50 EMA. If we get that cross, it's going to serve as an overhead resistance point in the low 90s. So as our members have a way of trading this, it works out very well. And members will go through this again in our weekly market watch Sunday evening. But it's just right now a directional trade. It's a directional bet that it's a 50-50 bet I wouldn't take. Nat gas, as you guys know, I've been long nat gas for a long time now. But I've been calling for this move here. In fact, I told our members right over here to short nat gas. All right, nat gas has a hard time in the U.S. staying over 9. I think it's going to eventually work its way back down to the low 6s, but not without another potential bounce higher. Another bounce higher, and then I think it'll be worthy of a short. All right, everybody, that's kind of where we're sitting right now. Just a quick overview of some of the major asset classes in the markets. Members, I will see you this Sunday evening at 8 p.m. Eastern Standard Time. If you're not a member, I highly encourage you to come in. We're knocking the ball out of the park this year. I think next year is going to be even more interesting for us. All right, everybody, have a great weekend. Members, I'll see you Sunday evening. Ciao, folks.